I don't know. But it just seems to be 2017 on steroids.
I mean, a big part of why, you know, this year has, played out the way it has is because it looks a lot like it did back in 2017, right? When the dollar went up a lot in Q4, then it came lower, and we're seeing that accelerated, here this time around, which then, of course, given that the dollar rose in Q4 back in 2017, we get economic growth during the first half of 2017, which is kind of what we've seen this time around, right? We saw city economic surprises come lower, and this is a large part of why tech stocks and things like crypto corrected in Q1. But then in the back half of that year, given the extent to which financial conditions eased or have back then, but also, in Q1, set the stage for the SESI or the economics data to come in above consensus expectations. But net financial conditions eased because the dollar came lower. And then if you just look at these charts over the same time, I mean, global M2 has exploded, right? So it's like, it just feels eerily similar.
That's bizarrely good. That's a bizarrely good
Yeah.
fit.
I mean, and I've just taken the same time period for all these charts. And so, a lot of what the Q1 weakness you saw, Felix, I'm sure you will have seen a lot of like the big strategists coming out.
Felix, to go back to the question you raised before is, look, here's something interesting, because 2017 was a big cycle for assets, as we know. I don't know, but it just seems to be 2017 on steroids.
I sort of feel like it is. Yeah, I don't think people want to admit this yet, but it does feel more powerful in so many ways, because like the way I think about it is, okay, you look at households, they're in their main liability is their house. They're in mortgage rates that they fixed for 30 years at 2.5% or whatever. And then on the corporate side, they were also able to term out a lot of their long-term debt. So they're good to go at those low rates for, I don't know, another 5 years easily. And then at the same time, you have this highly indebted economy where there's a lot of treasuries out there. Those treasuries, when you hike up rates, their income increases, their yield increases. And so you have this tension between the asset owners they have a bunch of their net worth in bills, and they're getting that interest income. And at the same time, their liabilities are fixed. So even if you jack up rates a bunch, it doesn't really matter to them as much. It's a pretty unique situation to the US. Like here in Canada, right? Mortgages reset every 5 years, no matter what. So like we're going to hit that wall in the fall, but in the US, it doesn't matter unless you move. So that's sort of been my framework, is that because of the fact that there's just so much debt out there, it's creating this dynamic where it's just increasing a lot. And I feel like people are still hesitant to admit that.